Hello everyone and welcome to the lecture of GST. GST stands for Goods and Service Tax, and I don't think there can be anyone who doesn't know about GST right now. It has been so much in news that sleeping and working and going anywhere and coming here and there, you always hear about GST, 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 GST. In fact, there is nothing else in this country for the last 7-8 months except GST. So everyone is aware of GST. So I don't have to go into telling you what is GST. Obviously, it is Goods and Service Tax, or as our Prime Minister says, good and simple tax. Now, how much simple it is and how much good it is, that you will understand in these lectures. Now, starting with the first chapter, Introduction and Constitutional Aspects. This is a very simple chapter, and in this we'll see the background of the GST laws, how these laws were made, what propelled the government to make these laws, what purpose will these laws solve. Now I'm always saying laws. Have you seen? Laws. Because GST is not one law. It is covered by 4 different acts and their rules and regulations and notifications and circulars and so on and so forth. Now, which are these 4 acts? We'll discuss them in due course of time. Okay. So in this chapter we are going to study about the constitutional aspects also, how the constitution gives the power to the government to make laws, and then how the government makes laws using that constitutional authority. We'll discuss a little bit about that. Then we'll see a few articles of constitution itself, which gives the power to the central government and the state government to make these laws, and what kind of laws can be made, and what are the division of powers, what the central government can do, what state governments can do. Okay, so all these aspects, and a little bit in brief about the formation of the GST Council and so on and so forth. Okay, so from marks point of view, you don't expect much marks on this chapter. 1 question, 4 marks at the most. Okay, so let's start. Introduction to GST. Now in this, the old system of indirect tax is referred, which had multiplicity of taxes. In the old concept, that is before GST, there were Excise Act charging excise duty on manufacture of goods. In fact, let me tell you in brief about indirect taxes. So first we'll discuss that. What is the meaning of indirect tax? Every indirect tax, now of course everyone knows what is indirect tax, right? It is levied upon one person. Levied also means imposed. Imposed by the government on one person and collected from him. The government collects the tax from him, but that person is allowed to shift the burden of tax to another person. So the ultimate liability falls upon the other person, because he ultimately ends up paying the tax. So therefore it is called as indirect tax. Like for example, GST is levied on Farooq Haque classes, right? So Farooq Haque classes has to pay, like the DVD that I am selling you or the pen drive, I will collect tax from you and pay to the government. So I have to pay to the government. Farooq Haque classes is liable to pay GST to the government on the pen drives that it sells. But then what I do, I transfer the burden of tax to the student, means the consumer, you can say. So I can transfer the burden to the student. That means that who ends up paying the tax? The student. That is you. You are paying the GST on the goods that I am selling to you. Okay, but you don't pay to the government, I pay to the government. So government imposes the tax and collects from me, the Farooq Haque classes, and Farooq Haque classes is allowed to shift the burden or transfer the burden of tax to the consumer. So I am recovering it from you and paying it to the government. So that is called as indirect tax. Means government indirectly collects the tax from this person. They are directly collecting from Farooq Haque classes, but indirectly collecting from the student, indirectly collecting from the consumer. So indirect collection of tax, that gives it the name indirect tax. Okay. Now, in the pre-GST era, that is when the GST was not in place, there was multiplicity of tax, multiple indirect taxes. Okay, so but before going into that, let me explain another point. So you now know what is indirect tax, indirectly collected from consumers. The other thing is, indirect tax is always levied upon an event. That is another important point you must understand right now, that all indirect taxes are levied, means imposed on certain events. Events means the happening of something. Okay, event means happening of something. So when that something happens, the tax is imposed. Now tax cannot be collected without imposition. Another very important point to note. It cannot be collected by the government without imposing it first. So if the imposition doesn't take place, means if the event doesn't take place. If the event doesn't happen, the imposition doesn't happen. If imposition doesn't happen, no collection can be done. So without imposing, you cannot collect. And imposition is an event. Means without that event happening, there cannot be any imposition, there cannot be any collection of tax. Okay? Clear and simple? Very good. So what were these different taxes? Let's see in brief. There was an excise duty. So there was a big act, and I used to teach it for 19 years, excise duty. And now it is gone. So it pains. After having so much of knowledge, if something is erased, something is gone, and the knowledge becomes useless, it seems bad. Okay, but nevertheless, now we have learned GST and we are teaching GST. But the important point is, somebody says that okay, GST is new, so anyone can learn and teach. It's not like that. All the wisdom that we have got, the old teachers I mean to say, including myself, because I was teaching excise for 19 years, and now in my 20th year of teaching, I have to teach GST. All the wisdom, the collective wisdom that you have about all the laws, about how the imposition takes place, how the collection is done, and lot many things. That collective wisdom carries on in GST. So if somebody says that okay, GST is a new law, let me learn and teach, he will not be able to tell you many things that I will be able to tell you. Because I know the background of the law. I know why this section has come in GST like this. Because what were the problems in the old law. So I know all the problems of the old law. I know all the good things in the old law. Okay. So what I'll be able to tell you is on a different footing. That is called as a collective wisdom. Okay. Now coming back. So excise duty was a type of tax, indirect tax, which was levied on the event of manufacture or production of goods. So excise duty was not on service in the first place. It was only on goods. And that too, on which event? The event of manufacture or production. Manufacture means bringing some new commodity into existence. Like there was plastic, and then I molded that plastic to form this pen. Now this pen is made of plastic, but you will not call it as plastic, you will call it as a pen. So what happens? A new identifiable commodity comes into existence. When this happens, a new identity comes into existence. Now you cannot refer this as plastic or piece of plastic, you will call it as pen. So when that happens, it is called as manufacture. And if that doesn't happen, if I just bring a piece of plastic, cut it into two pieces, it remains plastic. So if plastic remains plastic, is it manufacture? No. So can that activity be taxed with excise duty? No. So excise duty was not on all commercial transactions. It was only and only on the limited field of manufacture. If somebody brings a new commodity into existence, then yes, it is chargeable, otherwise not chargeable. Okay, so every value addition was not chargeable. Only manufacture was chargeable to tax. Then there was service tax. Service tax was imposed on provision of services. Provision. So provision means to provide. Provide means to give. Give service to somebody. So when the service was given by one person to another, that was chargeable to service tax. These two, both of them, were imposed by the central government. They were under the control and purview of the central government. Okay. Then there was sale activity. Sale of goods takes place. So on sale, there were two taxes. The state VAT, also known as the value-added tax, was there on intrastate sale of goods. So again, it was not on service, it was only on goods, and on intrastate sale. Intrastate sale means within a state. So if I'm a seller of Nagpur and supplying goods to a person in Pune, so the goods are going from Nagpur to Pune. So that was called as intra-state sale, that is within a state. It completes within the boundaries of one state or one union territory. It can be any state. So that state government, it was under the purview of state government. The state government could have levied a value-added tax. Okay, so that was called a state VAT. And obviously, it was levied by the state government, right? Then what about the sale which is interstate? Interstate means the sale begins from Nagpur and ends in Delhi. I'm sending the goods from Nagpur to Delhi. So the buyer is of Delhi. The goods are moving from Nagpur to Delhi. So that was called as interstate sale. Interstate, from one state to another. So on interstate sale of goods, there was a levy. But this levy was of central sales tax, in short called as CST. So there was a CST levied on interstate sale of goods. So both are sale, but intrastate came within the purview of the state government and interstate comes in the purview of central government. But there were a lot of problem behind it, and therefore there was central sales tax. I will not go into that right now because they have gone. So we don't have to do post-mortem of the old laws. But when the time comes, I will refer to some old provisions so that you understand the new law very clearly and conceptually. Okay, so there was central sales tax. Now I am telling you these points because these concepts are even in GST. We will study these concepts in GST also. Intrastate sale, interstate sales. Okay. So the point was that intra was within the purview of state government or the union territory, and interstate was with the purview of central government. But the tax that was collected here in the name of central sales tax was finally paid over by the central government to the state government only. So the money belongs to the state government only. But the law was made by the central government. The money was collected by the state government. Law by central government. Paisa, the money, goes to the state government. Now why it was so, I'll tell you sometime in detail later on. So these were the major laws, and then there were various other types of impositions, various, lot of them. We'll see in detail in a few moments of time. So there were many such levies, small levies on different things. Like you went to watch a movie, there was entertainment tax. Then you go to a hotel, there was luxury tax and hotel tax, and so on and so forth. There were many kinds of indirect taxes. So this problem was called as multiplicity of tax, and sometimes there were tax on tax, like excise. So when you sell the goods, when you manufacture the goods and then sell, first you had to levy excise. Suppose I am selling the goods at 1000 rupees and there was excise duty of 100, so I will charge 100 rupees excise duty, and then I will total it. So total comes to 1100. On 1100 I will charge the VAT. So VAT was imposed on excise duty also. So ridiculous. Okay. So there were so many such problems existing. To avoid these, government thought necessary to bring GST. In fact, the reason was not the problems. The reason was the problems were faced by the multinationals. We in India are used to problems. We in India are used to multiplicity of things. Okay. First we go and take PAN number, then we go and take Aadhaar. When we go for taking Aadhaar, they ask for PAN. When we go to take PAN, they ask for Aadhaar. Give us Aadhaar, then we'll give you PAN. The Aadhaar authority says, bring PAN and we'll give you Aadhaar. So which one should I take first? And then driving license, you take any of these. And then to do this, you take any of these. So we are accustomed. We Indians are accustomed for all kinds of multiplicity of problems. But the foreigners aren't. So when they come to do business in India, they were afraid of all these laws. And then, because there are so many laws, there has to be some kind of violation, voluntarily or involuntarily, right? Even involuntarily, there are so many violations we keep doing. And then when we are caught, we are troubled by the departments, so many departments to handle. So government thought necessary, and it was under pressure from the foreign investors, that you first modify your laws. You do reforms in your law system. We need one law and not several laws, 50 and 100 laws. So it was imperative for the government to change in order to bring the foreign exchange into India and to invite the foreign investors, the foreign businesses. So they had to do it. So what they did, they cancelled out all these laws and merged them into a single law called as GST. It's a single tax. Though there are 4 laws, but it is one tax. Tax is one, GST. So everything converged into GST. Okay. So when it converged into GST, this is one aspect. Now I'll explain you another aspect which nobody tells and which is very important to know. So now what happens is that there is no excise duty. So these events of taxation have also merged. So now you can you don't see manufacture, you don't see sale. All these words or provision of service, all these events have converged into one word, and that is supply. So all these acts or the different types of taxes, you can say, got converged into GST, and all these events of taxation got converged into one activity, one event, and that is called as supply. So now we'll only call it a supply of goods or supply of service, or both taken together. So GST applies to both, as the name itself suggests, goods and service tax. So it is on supply. What is the event of taxation? Remember this, we'll study it in detail in chapters to come. There is a whole chapter of supply. Section 7 we'll see what is supply. But right now you remember, supply is the word, is the key word, is a very important word. So supply is the event of taxation. What is supply? It is event of taxation. Or what is the event of taxation in GST? Supply. Supply of what? Either goods alone or services alone, or combination of goods as well as service. Okay. So GST is on supply of goods or service or both. Now another thing I'll tell you in the background before we actually start reading, that if the supplier, so if the event is supply, the person who supplies is called as the supplier. So understand these basic points, and therefore you will not face any problem later on. So the person who supplies is the supplier, and the other person to whom it is supplied is called as the recipient. Okay. So mark these words, put them in your head: supplier and recipient. So supplier supplies. So supplying is the event of taxation, goods or service or both. Goods or service or both. So this is the event of taxation. Supply is the event of taxation. Okay. Now supplier is the person on whom the tax is imposed. So imposition or the levy takes place on the event, and on whom, because levy has to be on the event, of course. But who will pay tax? The supplier will pay tax. So, but in GST there are two modes of recovering taxes. One is called as the forward charge, one is called as the reverse charge. So okay, so I'm going in deep, but okay, let's see all these things. I'll tell you in a very informal way without referring to any sections, so you will remember these things. Anyone can understand these things. You don't have to be a chartered accountant for that. So supplier has to pay tax. So if the levy is on the event and on a person. Levy has two things. It is on the event and on the person. Person becomes liable to pay tax. So who becomes liable to pay tax? So if the levy is on supplier, then that is called as forward charge. That is called as forward charge. So in forward charge, what happens is that the supplier has to pay to the government, but he can transfer the burden to the recipient. So ultimately the amount comes from recipient to the supplier, and supplier pays it to the government. Okay, so that is called as a forward charge. Then there is a mechanism called as reverse charge. In few cases, not all cases, in few cases, the defined cases, section 9 we'll see later on. Okay, sorry, I was not going to refer to sections. Okay, so forget 9. So we'll see the provisions later on, which will say that in some few cases of supply of goods or service or both, instead of the supplier, the recipient will be liable to pay tax to the government. So if the levy is on recipient, then that is called as a reverse charge. So in forward charge, the supplier pays to the government, and collects it from recipient, right? He pays it, but then he collects it from the recipient. And in reverse charge, what happens? The recipient pays tax to government directly. So the supplier doesn't collect it from the recipient. So recipient pays the tax directly to government. So ultimately it results in the same thing. The burden in both the cases ultimately falls upon the recipient only. But in forward charge, the collection will take place and then the payment, or the payment and then collection. It can either ways. Either you receive the amount and then pay, or you pay and then you receive the amount from the recipient. But ultimately you will receive. Okay. But in reverse charge, the supplier sleeps. He doesn't do anything. The recipient directly has to pay the tax on the receipt of goods or service to the government. So when I say that the levy is on supplier, so that is forward charge. So it is on supply. And when I say it is on recipient, it is called as the reverse charge. So it is on basically the receipt. So this is on supply, this is on receipt of goods or service or both. Done? Simple? Good. Now, what are the different laws in GST? Let us discuss in brief about that. So this supply can be intrastate or interstate. The supply can be intra or inter. So intra will be when the supplier, the location of supplier and the place of supply. Now there is a whole chapter we have to discuss, place of supply. It has several sections in it which defines what is the place of supply in different types of situations. So there are more than 20-25 situations given there for goods and services taken together, and it determines, there is a whole section on that which says that in this case the place of supply will be this, in this case the place of supply will be that, in this case the place of supply will be that. So we'll have to see that whole chapter for that, place of supply, very interesting chapter. And we'll also see the definition of location of supplier. So all these things we are going to study. But right now you just remember that if location of supplier and the place of supply is in the same state or the same union territory. Like for example, location of supplier is in Pune and the place of supply is in Mumbai. So this will be called as intra-state supply. Intra means within one state or one union territory, okay, within. If this is the case, then the tax that will be imposed, or rather the taxes that will be imposed, will be the central tax. So central tax is called as Central Goods and Service Tax, CGST, and the state GST. Or if so here it will be Maharashtra GST. Okay, Maharashtra state GST will be imposed because both these places are in the state of Maharashtra. If this is in a union territory, then it will be imposed as UT GST, Union Territory GST. So SGST has to be there, or UT GST and CGST. So CGST will remain CGST whether it is in a state or in a union territory. But if it is in a state, then CGST will be coupled with SGST, and if these two places are in a particular union territory, then it will be that union territory GST. Okay, so it will be called as UT GST. Now, whatever is the rate of GST, say for example government is wanting to impose 20% GST. So it will be broken up into two pieces, equal pieces. So CGST and SGST will have the same rate. This is important. They will have the same rate always. So if total is say 20, then this will be 10 and 10. If total is 18, then these will be 9 and 9. If total is 12, then these will be 6 and 6. So up till now you have purchased a lot of goods and you have gone to restaurants and you have done this and that and lot many things, right? Have you ever seen the bills that you receive? It will always have those two components, CGST, SGST, and you will always find their rates same. They'll have same rates. Okay? So understood the three laws we have covered here. CGST has its own law, which we are going to study now, the CGST Act. Similarly, you have got the SGST Acts in each state. Now these SGST Acts will have almost common provisions as CGST Act. Okay, all the laws will remain same. Only thing is that it is for imposition of Maharashtra state GST. Then there will be a law in Karnataka, there will be a law in Tamil Nadu, there will be a law in Gujarat and MP and Uttar Pradesh and everywhere. Similarly, the UTGST Act. So these are 3 laws. Have you written? Taken down? If no, then please do it, so that I'll rub and then take another example here. Okay, let me write a new example. So now let's see. The location of supplier and the place of supply. Now if these two are in different states or different union territories, or one state and one union territory. For example, the location of supplier is in Pune, but the place of supply is in Delhi. Okay, so this will be called as interstate supply. You don't call it as inter-union territory, you call it as interstate only. Okay, so even if that is a union territory, you will call it as interstate supply. Now in case of interstate supply, the CGST and SGST will not apply. Instead of that, you will apply IGST, Integrated Goods and Service Tax. Now this IGST is nothing but the aggregate of CGST and SGST. So if CGST is 10, SGST is 10, so aggregate is 20, the total GST is 20, so that 20 is IGST. So IGST will be directly 20% or 18% or 12%, as the case may be. There are different rates. There are many different rates. So understood, that is a composite. It's a composite of both the components. Therefore it is called as I. I stands for integrated. Integration means taken together. So which two things are taken together? The CGST and SGST. So it's a combination or composition, you can say, or aggregation. Different words you can use. Okay, I'll use the word aggregation. Is the aggregate of CGST and SGST or the UTGST. Okay, so if you take any particular goods, any particular good, like for example this pen, if IGST on this is say 20%, so if I sell in interstate, I'll pay 20% in the name of IGST, and if I supply it within my state, I will pay same 20% but divided into two components, 10 plus 10. 10 will be C and 10 will be S. Okay, so it is the rates will always be correlated. It cannot happen that IGST is 25% but CGST, SGST is 20%. That cannot happen. Okay, the rates cannot be different. So understood this point? Very simple point. And these are very important points. They are very simple but very important. So these are like saregama of music. You have to understand them. Unless you understand these points, you will not be able to understand anything in this whole law. So done. Now you know what is intra and what is inter. Very good. So let's see. And then there is another important point I'll have to explain, and that is the concept of credit system, the tax credit system. But I'll explain it after some moments of time. So let's see. The old system of indirect taxation had multiplicity of taxes levied by the center and state. This had led to complex and conflicting indirect tax structure, adding to multiple compliance and administrative costs. You had to incur different compliance and administrative costs. because you had to go to sales tax department also, and you had to go to the central department, the excise department, then you had to go to the service tax department, and so on and so forth. So much cost was involved, and the hidden cost, of course. Now I cannot say anything about that in the lecture, but you know what I'm talking about, right? You had to entertain so many officers of different departments, and there was no uniformity in tax rates and structures across the states. Some state was charging 20% on some goods, and some another state was charging 10%. So that was again a different problem, different tax rates on the same goods in different states. But now in GST that will not happen. The rate of GST on some goods in Maharashtra will be same as in Andhra Pradesh, as in Telangana, as in all other states. Then there was cascading of taxes due to tax on tax. I just explained it to you. Sales tax was imposed on excise duty also. Then there were too many restrictions on seamless credit available. Too many restrictions on credit system. This I'll explain you in some moments of time. So in credit, like earlier there was SENVAT credit system. So excise duty credit was allowed to be taken and set off only against excise duty. Sales tax credit was allowed only to be set off against sales tax. Sales tax credit could not be set off against excise, or excise credit cannot be set off against sales tax. So each law had its own credit system, and with lot of restrictions also. Like it is given, credit of excise duty and service tax paid at the stage of manufacture was not available to the traders. Traders were not allowed to take excise duty because they didn't had excise duty on their output. I'll explain this point. While paying state level sales tax on VAT. So excise credit could not be set off against VAT, and vice versa. VAT credit could not be set off against excise. Further, no credit of state taxes paid in one state could be availed in other states. Now this problem still exists in GST, but it can be resolved. I'll tell you how. So then it is given that GST, which subsumes and collects all these taxes, large number of central and state taxes into single tax, is meant to mitigate the cascading effect of taxes. Mitigate means to solve the problems, provide near seamless credit, and make way for common markets. So common markets means that everywhere the tax rates will be same. So it doesn't matter that you purchase goods in Andhra or you purchase goods in Punjab. They will come with the same rate of tax. Okay, so should I explain you the credit system right now? Let's see. Now what happens in how the credit system works, let me tell you. But to understand credit system, first you have to understand the cycle, the cycles. Now, as I've told you that indirect tax is on events, okay, is on a particular event. So when that event happens again and again and again continuously, then that becomes a cycle. So when there is a recurrence of event, of taxation. What is the cycle? Recurrence of event of taxation. For example, here is a manufacturer of what we call as threads. So what he'll do, he'll bring cotton as a raw material and manufacture thread out of it. Okay, then he sells the thread to a second manufacturer of cloth. So see, his event is manufacturing, and his goods go to another manufacturer who again makes something else out of it. So it is again manufacturing. So it is a recurrence of event, manufacture, then again manufacture. Then he sells the goods to manufacturer of ready-made garments or different kinds of products out of cloth. So he's again a manufacturer. So see, the event of manufacturing is happening 3 times continuously. The input, the output of one person, the finished goods of one person becomes raw material for the second person. Then his finished goods become raw material for the third, and his finished goods may become raw material for the fourth, and so on and so forth. It can happen so many times. The cycle can keep going on for maybe 8 to 10 times in some cases. So when the event happens again and again and again, continuously in the hands of different people, there will be tax. So first person will pay excise duty on his manufacturing. Second person will again have to pay excise duty on his manufacturing because he is also a manufacturer. And the third person again has to pay excise duty on his manufacturing process. Okay. So excise duty will be charged 3 times on their sale prices on the full value. So if they have to pay tax on full value again and again, that will bring double taxation, because the value addition of the first person will become cost of the second person, and then he will add certain more value to it and sell at a higher price. Say for example, let's take an example that the transaction value, sale price is called as transaction value here, is 100 rupees here. So second person buys at 100. So this 100 for him becomes cost. Plus he makes some value addition of another 100 rupees and sells at, so his selling price, or I can say transaction value, becomes 200. He sells it to third person. For him the cost will now become 200. Then he will make value addition of another say 300 and sell at 500. Okay. Now if we were to charge tax on 100 in his hands, the first person's hands, so he pays tax on 100. But if you charge tax on 200 in the second person's hands, then this 100 will also become taxed. So this 100 which has already been taxed here will be taxed again. And then if you were to charge tax on 500 in the hands of the third person, then this 100 which becomes cost here and it carries over here will be taxed for the third time. This 100 will be taxed one time here, one time here, and one time here. Then this 100 value addition will be taxed once here, and then becoming part of the cost, it will be taxed again here. And this 300 value addition will be taxed for the first time. So the value additions of the earlier people will be taxed again in our hands. So that becomes double taxation, or the cascading effect. So to avoid that, there was a system of CENVAT credit. In the old excise laws, there was a system of CENVAT credit, Central Value Added Tax Credit System, which said that if the tax paid here, if the first person, let's take a excise duty rate of say 10%. So first person pays excise duty of 10 rupees at 10%. The second person will be first charged excise duty on the full transaction value. So we will charge tax on full 200, so that comes to 20. But he will not pay 20 to the government. This 10 will be allowed as credit to him. So this 10 rupees will be allowed as credit, means will be allowed to be set off. So this was called as CCR, CENVAT credit of 10 that was set off, and he will have to pay only 10 rupees to the government. Similarly, the third manufacturer will first charge excise duty on the full transaction value of 500. So his duty will come to 50 at the rate of 10%. Then this duty of 20 which is charged here will be allowed as credit to him. So this 20 will be allowed as CCR to him, and he will pay only 30 rupees to the government. So now what happens, that we avoid the double taxation, we avoid the cascading effect. So each person is in a way paying tax only on his value addition. Okay, each person is paying tax on only their value addition and not on the cost of the earlier person, on which tax has already been paid by the earlier person. So it's simple. But the problem was that right now this is okay, this is fine. But now this manufacturer of garments sells the goods to a trader. So as soon as the manufacturing cycle ends and trading cycle begins, are you understanding? There are different cycles because there were different laws. So manufacturing came under excise, so excise cycle was manufacturing cycle. Trading comes under sales tax, so a new cycle begins, trading cycle. So the excise duty that was levied here in the last transaction 50. So this guy is going to sell the goods at 550 to the trader. But trader will not be able to take credit of this 50 because this is excise credit. He will not get excise credit because his output liability is not excise. His output liability is sales tax. So this credit of 50 could not be set off against his sales tax liability. So what happens here? That for him the cost will now become 550. That is the transaction value plus excise duty. So this guy is selling at 550 to the trader. 500 plus 50. So he recovers 50, but he pays 30 rupees to the government. But he's recovering 50 from trader. So now trader will record cost as 550 because he is not getting credit of that 50. Because this is excise. Excise credit will not be allowed to a trader. And if he makes value additions of say another 150 and sells the goods at transaction value of 700, okay, so on his output there will be only VAT, that is the sales tax. This VAT, if suppose is say 70, he cannot use this 50 to pay VAT. No set off. No set off. But then I'll add something to this. This is the excise duty that these people have paid. But these are manufacturers, so they manufacture the goods. So on manufacture there is excise duty. But then they are selling it also. After manufacturing they are selling it. So there will be sales tax also. So all these people will pay sales tax, means VAT also. Okay. So let's add VAT. So if the first person is paid VAT of maybe 8, the second person, now again the same thing will happen. The second person will get credit of VAT under VAT laws. Okay. Under VAT laws he will get credit of 8 rupees, and if his output liability is say 14, he will get set off of 8 and pay the difference of 6. So if I say 14 minus 6 is equal to 14 minus 8 is equal to 6. So he pays 6, and the third person I hope you are able to see, though it is going below the screen, but you can write as 6. So his output is 8, his output liability is 14. By setting off 8 he pays 6. The third person's liability is say, okay, I'll do one thing. You have written this excise component. Okay, I'll now delete this. So you will write below the excise that the first person's VAT liability, now we will talk about VAT liability, is 8. So he'll pay full 8 because he's the first person in the cycle. He doesn't have any credit. The second person, if his VAT on output is 14, he will get set off of 8 and pay 6. If the third person's VAT liability is say 22, he will get set off of 14 and he will pay another 8. the difference. So these are the manufacturers who first paid excise and now they are paying VAT also. So they have to pay both. Manufacturers had to pay both, because after manufacturing they were also selling. So they had to pay both. On manufacturing they had to pay excise, and then on sales they had to pay VAT. Now this 22 which is there now, can this be set off by this person, the trader? Answer is yes. So this 22 is the VAT credit that can be set off by the trader also. So he can set it off 22 and pay the difference of whatever it may be, 48 I think. So he'll pay 48. So that is allowed. But excise of 50 would not be allowed as set off. But VAT credit will be allowed as set off. Understood? Very good. Take it down. So conclusion is, in old laws, that excise credit could be set off only against excise duty and not against VAT. So not allowed against VAT, and VAT credit was not allowed against excise. So that was given there in the first para. Then moving ahead, goods and service tax. Idea behind GST, one nation, one tax. Now it is called as one nation, one tax, but as you have seen just now, there are how many taxes? There is central tax, there is state tax, there is union territory tax, and there is IGST, the integrated tax. So all of them are GST only. It's one tax, GST, but divided into 4 different acts. So it says goods and service tax, which is globally known as VAT also. So some countries call it as VAT, some countries call it as goods and service tax. Is an old concept which was first implemented in France. Various countries across the globe have implemented GST by adopting different models, the details of which is as follows. There are different models. These are called as the models of GST. One is called as the national GST. National GST means only the central government recovers the tax and not the states. So that is applicable in Australia, in China. Then there is state GST, where only the state governments recover the tax. The central government doesn't tax. Central can tax incomes and state will tax GST. So that is applicable in USA. In fact, in USA, even the income tax is recovered by state governments only. Then non-concurrent dual GST. That is, center levies GST on services and state levies GST on goods. So they have divided goods and services amongst them. You charge tax on service, we will charge tax on goods. So that is, but there are no examples of any country there. But the concept is there. And then the concurrent dual GST, which we have followed. So there is a tax levied on tax levied by center and state on both. So that's why we saw that we will not divide the goods and services amongst ourselves. We will both charge on goods and service, but divide the tax amongst ourselves. Whatever tax is there, we will divide. So you charge 9, we will charge 9. It's like that. So Brazil, Canada, India are the examples here. Then again it is explained what is concurrent dual GST. So it strikes the balance of fiscal autonomy between central and state. Fiscal autonomy means both the central and state governments in India under the constitution have the power to impose tax. So both of them will levy their part separately. I want my separately, you take yours separately. Then both level of government levy tax and cross set off of input tax credit is not allowed. I'll tell you, this is the main problem. Cross set off is not allowed. Means if you have paid tax in Maharashtra state tax, you cannot set it off against Gujarat tax. And tax on comprehensive set of goods and services means both charge on both goods and services. Then structure of GST in India. So I just explained you all these points. There is CGST, SGST, UTGST and IGST. And below that it is also given that the union territories, there is a list of union territories also given. This is the complete list of union territories, and they are divided into two: having state legislature and not having state legislature. So there are two union territories which have state legislatures. They have state government, you can say. State legislature means the state government is there. Delhi and Puducherry. So in these two states you will charge SGST and not UTGST. Okay, but in these union territories, Andaman and Nicobar Islands, Lakshadweep, Dadra and Nagar Haveli, Daman and Diu, Chandigarh and other territory, anything which might be there, these places will charge the UTGST because the states doesn't have a government. So I mean to say the union territories don't have a government. So in this case, the law itself, the UTGST law, has not been passed by their governments because they don't have any. It is passed by Parliament only. So Parliament looks into the administrative affairs of these union territories. But these union territories have their own governments, the Kejriwal government, and Puducherry I don't know who is there. So they can manage their own thing. So they have passed their own laws called as SGST. Then comes applicability of GST. Very simple. It applies to whole of India now. Originally when the law was imposed from 1st of July 2017, Jammu and Kashmir had not passed the resolution accepting these laws. So it was not applicable. But later on, it was passed by their state legislature, and now it applies to the whole of India, including Jammu and Kashmir. So therefore it is given the CGST Act applies to whole of India. Earlier it was written except Jammu and Kashmir, but it was omitted by the Central Goods and Service Extension to Jammu and Kashmir Act of 2017 with effect from 8th of July. So they were a little bit late, 1 week late you can say. But it was retrospectively brought into force from 1st July itself, so there is no problem. Similar is the case with IGST. It applies to whole of India, including Jammu and Kashmir now, from 1st July 2017. Union Territory Goods and Services Act, same way applies to the particular union territories. These are those union territories which do not have their own state legislatures, effective from 1st July 17. And similarly, the state GSTs are not given here, but they are also applicable, because then we have to see all the 29 states. Each state has passed their own laws separately, but they are not in our course because 29 laws we don't have to study. Then moving ahead, there is a definition of India. Definition of India means the taxable territory. This is called as taxable territory also, in the sense that if the event happens, event should happen in this place. The event should happen in the taxable territory, means the supply should be in taxable territory. If the supply is not in taxable territory, then it cannot be charged with GST. Okay, so what is the taxable territory? Let's see. Very simple definition. First of all, India means territory of India. Territory of India means the land mass of India. The land mass, all the land mass that we see, that is the territory of India, including Jammu and Kashmir. Then its territorial waters. Territorial waters extend up to 12 nautical miles into the sea. The sea water up to 12 nautical miles is territorial water. So that is also India. Then the seabed. Seabed means the seabed beneath the water. Okay? Seabed and subsoil underlying such waters. Such waters means 12 nautical miles. So up to 12 nautical miles, the water is also in India, and the seabed beneath it is also India. So some goods may be supplied in the seabed, some goods may be supplied on the water, or services can be rendered on the water, or services can be rendered on the seabed. It will be called as India. Then continental shelf exclusive economic zone or any other maritime zone as referred to in Territorial Water, Continental Shelf Exclusive Economic Zone and Maritime Zones Act of 1976. This is one name, huh? Right from here till here, it is one name. You have to speak out in one breath. This, you forget about it, forget the names. It extends up to 200 nautical miles. But this is only water. This is water. So the water extending up to 200 nautical miles is also India. And lastly, the airspace, the air above the territory means the landmass and territorial waters. All the air which is above. So in air they can be supplied. Supply of services, aircrafts, transportation of passenger service, transportation of goods by using aircrafts. So for that purpose they have used this word airspace. So very simple, and you can understand from this diagram also. So this is the landmass, of course. So the whole landmass is India. Then if we talk about the sea, up to 12 miles is the 12 nautical miles is the territorial waters. So up to 12 nautical miles, the subbed and the seabed and subsoil as well as the air, both will be considered as India. And then from this to 200 nautical miles is the exclusive economic zone. That will also be called as India. So if any goods are supplied or any services are rendered in this place, it will be taxable. The levy of GST, very simple, is on what? Supply. So this is called as a taxable event. I explained it to you. Supply. Supply of what? Goods or service or both. Then below that, the genesis of goods and service tax is given. This is for you to study. I will not interfere in this. This is the political history of the law of GST, how it came into place. So this is up to you. But read it once. It's interesting. The timeline of the GST law. Then concept of GST Act. GST, sorry. It's a value-added tax because of the credit system that we just saw. So the example that I gave you of the old SENVAT and VAT is the same that will continue in GST also. But in GST what happens is that you don't differentiate excise and sales tax because it is one. GST is one. So GST is an amalgam, a composition or the subsumation of both the acts. Both the type of taxes, the excise and the state tax, the VAT. Therefore, credit is seamless. Means you don't differentiate. So earlier the problem that was there, we just saw in the example, that excise credit was not allowed against state VAT. Now that problem is gone. GST credit is allowed to be set off against GST on output. So it's simple. So it's a value-added tax. That is tax levied on value addition. Then there is comprehensive and continuous chain of tax credits. So this chain, I explained it to you, the cycle. Chain also means the cycle. The cycle of manufacturers, service providers, traders, all types of businesses. So there is a continuous chain, and till the time the chain continues, the credit system continues. But in the last sale means the sale or supply to consumer. That is when the cycle ends. Consumer never gets any credit. So final burden falls upon the consumer. So till the time the burden keeps on shifting, and finally it falls upon the consumer. So when you buy a liter of petrol, a burden of 30 to 35 rupees is imposed on you, is passed on to you, and it is dumped on your head of different types of taxes. But right now it just came to my mind the example of petrol. Petrol is not covered by GST right now, but it is covered by all the other state and central laws, the different taxes. But if you take any other example like this pen, so when you buy a pen, you get a bill. In that bill, that amount is written CGST, SGST or IGST. That is the burden which has fallen upon you. So now what you do is, in this year, in the coming year, you collect all the bills of all the expenses that you make throughout the year. Okay, do this exercise. It's a very interesting exercise. Collect everything, all the bills, and maintain a personal expense record. So you go and eat out in a restaurant, or you go to some gym and pay the amount to the gym, and you go to travel somewhere and you pay the amount for travel, and you go to watch a movie, and you go to an entertainment park, and you go to an amusement park, and you go here and you go there, and you do this and you do that. All the expenses you record. Make two columns: the net expense and the GST that has been paid on it. And then at the end of the year, just see this register. Just take the total, and you'll understand how much taxes you are paying to the government in the course of the year. Very interesting exercise. And you go on a picnic, you go on a tour, and you pay to the tour company, you pay for your flights, you pay for this, you pay for that. Everything you pay, there is a GST component attached to it. So just take the total and then see how much you are contributing towards the development of this nation, this great nation. It will be so interesting. Now even I have to do it. I don't keep these records. I'll also start doing it. You also do it, I'll also do it. Okay? And then credit of GST, this we'll understand later on in detail. Here a simple example is given to explain it to you. Like I gave that example earlier, that this is the person, he charges GST of say 500, the first person, and he supplies goods to manufacturer. Manufacturer will charge say GST of 1200, and this 500 will be allowed as set off. So here the set off is called as ITC. ITC stands for Input Tax Credit. Okay, it is called as Input Tax Credit. So this 500 will be set off here, and he'll pay 700 to the government. Then he sells the goods to a wholesaler. Wholesaler then sells it to a retailer. So he will charge GST of say 1500 and set off this 1200. So this 1200 will get set off here, and he'll pay 300. Similarly, the next person then sells it at 2000. So this 1500 will be allowed as set off here, and he will pay the difference of 500. And ultimately, this 2000 rupees burden will fall upon the consumer, the end consumer. Then no cascading effect of tax. So there will be no tax on tax in GST because we are allowing the credit. So there will be no tax on tax. It doesn't differentiate the excise and this and that separately. So GST, GST, GST. So at no place there will be a tax on tax. So all simple points. And then taxes to be subsumed and not to be subsumed in GST. Which taxes are subsumed and which are not. This is one area where question may come. So you must remember this point. So state and central, all the taxes that have been subsumed. Let's see. In state there was VAT. VAT means the sales tax. Then at some places there was purchase tax. Then entry tax, octroi or local body tax. This was when the goods used to enter your city. There used to be a tax called as entry tax or octroi or local body tax. So even they have been subsumed in GST. Then sales tax partially because there are few goods which are still left out of GST. So what are excluded? Excluded are the right now is alcohol, that is daru, alcoholic for human consumption, alcoholic drinks, liquor, and petro products. So petro items are left out right now. Petro items will be covered later on, but alcohol will never be covered in GST. There is no intention to cover alcohol in GST. So sales tax will continue to apply on these goods. So these are exceptions. Otherwise all other goods are covered by GST. Then entertainment tax, that was tax on different entertainment events like movie and all. Luxury tax on hotels, betting, gambling and lottery. There was a separate tax now covered by GST, and surcharges and state cesses. Similarly, in central excise duty, additional duty of excise, then additional duty of excise is in customs, so this you will understand in custom. Then excise on medicinal and toilet preparations act. Then there was additional customs duty equal to excise. This also you will understand in customs. And then special additional duty. This also you will understand in customs. Then surcharge and cesses, central sales tax, and service tax. We also write down service tax. So all these are subsumed in GST. And below given are taxes not to be subsumed. So in that, the customs duty itself. Customs duty, that is on import export, is not covered in GST. They are still levied separately. Customs Act is separate. And in customs there is anti-dumping duty also, there is export duty also. They are also separate. All types of customs duties, you can say, are not covered by GST. And from state's perspective, property tax. Property tax means the taxes which are levied on your property, buying and selling of property, or also called as the stamp duties. Different kinds of stamp duties are there. Electricity tax, road and passenger tax which you pay on your vehicles, purchase of vehicles, and toll tax that you pay on crossing tolls, use of the roads and bridges and all. So these continue to be levied separately. They are not covered by GST. And then a few benefits of GST are given. This is also for just reading purpose. There's nothing to explain there. Creation of unified national market, because there will be no different rates in different states. Earlier what used to happen, that some state used to allow certain goods on a very concessional duty. So their market rose, and if the same competitive industries there in other states, they used to suffer. So all the manufacturers would try to shift their units in that state, which is giving concessional sales tax rates. So there was what we can say non-uniformity in the market creation, but now that point has gone, because the same rates will apply everywhere. So there will be no economic barriers for creation of industry. Then GST is a win-win situation for the entire country. Very simple. Boost to Make in India initiative, buoyancy to the government revenues. Government revenues will increase because of levy of GST, because all tax evasion will stop basically. So people will pay more tax. Widening of tax base will happen. Elimination of multiple taxes and double taxation. So the compliance cost and all will come down. And mitigation of ill effects of cascading. The cascading effect will stop. Tax on tax will stop. So that was the first part. Here we'll take a break, and in the next lecture we'll see all the constitutional provisions, the articles of our constitution, which gives power to the government to collect the GST.